Good evening, everyone. My name is Mike Carterell. I am Community Manager for CyberBrokers, and we are here for a CyberSesh named NFT and Crypto Tax Masterclass with Justin McCormick from Founders CPA. Want to give us a brief background, Justin?
Yeah, sure. Hi, everyone. My name is Justin McCormick. I'm a senior associate at Founders CPA. I've been helping businesses and individuals with their crypto taxes and crypto accounting for roughly the last 2 years now. My background's in computer science and law, so I also have a Juris Doctorate, which is where I started to get into crypto taxes myself, and it's been a fun journey ever since. Since you're here, obviously my firm that I work at, we do the accounting for CyberBrokers, which is always a fun one. A lot of royalties, just pretty massive data set as far as things go. And then I help other businesses, generally not as complicated, some other NFT companies, and then individuals ranging from, your small kind of like mom and pop portfolios to SHIB or Doge millionaires to just giant whales that make CyberBrokers look small. So I've seen a lot, here to hopefully share some stuff with you guys, and if you have any questions at the end, I should be able to answer them or at least point you in the right direction. So that's going to be my background.
Great. Are you a company focused on U.S. or do you go to other countries?
Correct. So we specialize just in U.S. taxation and accounting. Unfortunately, when you take it beyond that scale to global, it gets even more ridiculously complicated, and the U.S. doesn't even have a lot of answers yet itself. So we decided to just pick a region, the one that we're all sort of local in, and stick to that for now.
And I can say they're very thorough because I am constantly getting reminders of what's this transaction, please document it. So very thorough.
Yep.
Let's get into it then. So you've got a presentation and we'll kind of start walking through that. If people have questions, feel free to unmute and ask or type in the general chat and we'll go from there.
Perfect. So this is a slide deck that I prepared. It's not going to cover every question that you can have. So if you have one while I'm going through it, feel free to ping me in the open chat, get off of the mute button or have ping Mike and he can ask the question as well. So we're going to be going over crypto tax basics specifically like cryptocurrencies at large and NFTs. This is, CyberBrokers is a pretty big NFT community, so that's going to be a large portion of this slide deck. Although to me, I think NFTs are pretty simple. So we'll see. So topics that we're going to be going over is understanding what a crypto reconciliation is. This is a term that might be new to you. This is a term that if you're actually doing more than just buying cryptocurrencies, which odds are, if you have a CyberBrokers NFT or any of the other collections, you're going to be needing to do this every single year. Essentially, this is just preparing your crypto taxes or accounting. The next topic is going to be fundamentals of crypto taxation. We're going to go over some of the high-level basics, navigating NFT taxation, then exploring tax loss harvesting, strategic long-term tips, and then last but not least, our crypto hub access. So kind of the free prize at the end of all of this will be, I call it a crypto hub. It's sort of like an online forum-ish website that has a lot of other great content. We go into things a bit more in depth. So when the time comes and you want to go down that rabbit hole, you can. So, firstly,
Justin, we should break for a moment and put our disclaimer in here that while this is a knowledge session, this is not legal advice, accounting advice, or financial advice. You should always talk to someone directly, right?
Well said. So this is all just sort of high-level concepts. Everyone's data set is going to be unique. Your actual fact pattern is going to be different than everyone else's. And so if you have a question, you definitely are going to need to go to a tax professional and someone that's actually engaged, which means signing a document that says that they are. Otherwise, everything, like you just said, not financial advice, not legal advice, and use at your own risk.
Thank you.
Yep. So going over crypto reconciliations. This is the process of consolidating all of your cryptocurrency data into a single data set and ultimately generating the final tax report. So here are the 6 key steps. First step is gather all your data. It sounds pretty simple, and for the most part, at this point, it is. There are a lot of crypto tax offers out there, such as like Coinly, Zen Ledger, crypto tax calculator. Most of the time, it's just putting your wallet addresses or some exchange CSVs or an exchange API. Just getting everything into the software. That's step one. Step two is ensuring accuracy. This is where most people go wrong. Just putting your stuff into a software isn't going to get you correct results, unfortunately. All they sort of do is pull data. They don't actually read it correctly or process it correctly. And unfortunately, everything's still in its infancy stages, so all of that legwork is on you, the taxpayer. Here you address any errors. You probably don't know which errors go to which software. And that's sort of, unfortunately, kind of like trial and error. You need to know your data set regardless of the software to be able to spot the errors. This is where if you're doing something complicated, I highly recommend going to a professional. As generally most firms have at least one software sort of ironed out. The next step is going to be analyzing your transfers. This is often in the accounting world referred to as like a bank reconciliation. You're going to be looking for your deposits and withdrawals. So like if you're moving an asset like Ethereum from your Coinbase to your MetaMask to buy an NFT, you're going to want to mark those as a self-transfer. The next thing is updating your unmatched. So after you go through that lengthy process of matching all your deposits and withdrawals, which are non-taxable self-transfers and don't affect your holdings, depending on what you did, you may have items left. Those are called unmatched transfers. These are the things you're going to want to review. Things that I see in unmatched transfer lists are like staking income, mining income, maybe you're staking an NFT for some other sort of reward, things like that. Or if you're using a marketplace that isn't like OpenSea or Blur, that is more of like escrow-ish, essentially where you put in Ethereum or an NFT in one transaction and get the reverse on the other. If it's not all in one transaction, those are going to show up on the list. You're going to want to make sure you account for them and verify that the data is correct. The fifth stage is verifying the final data set. This is kind of just for like a simpler data set. You can skip this. For the big boys, you're definitely going to want to sit down and double check everything. This is kind of going through like your asset symbols, making sure they're correct, going through like the pricing. If there's crazy variances, sometimes the software will pick up a price oracle for an asset that has like a very similar symbol. Like an example that I've seen in the past is wrapped ETH. There is a contract address for that on Ethereum, and anyone else can also make a wrapped ETH contract. And so I've seen softwares pull in crazy numbers because they're pulling the wrong one. So this is just kind of like the last high-level review. And then step 6 is generating your financial report. Generally in a software, this is going to be clicking generate tax report. And that's your last step. You're going to want to check through your capital gains and your holdings and then just make sure everything looks correct. If you see anything incorrect, like you should have, for example, let's say you have CyberBrokers number 10 in your holdings and you don't see it in the tax report, that's going to tell you that something went wrong and you're going to need to go back and find out where in your data set. So by following these steps, you can effectively consolidate and reconcile your cryptocurrency data, ensuring your tax reporting is precise and compliant.
So this is something I kind of miss with Bitcoin. Most Bitcoin wallets had like a notes feature. So every time you'd make a transaction, you could put a little note there. And Ethereum wallets like MetaMask don't seem to have this. Is there any wallet you know of that does have like note taking in it?
Unfortunately, not for EVM yet. I think someone should definitely sit down and make that. It is a great idea. My recommendation always is just to kind of keep like an Excel or Google Sheets in a Google Drive or like a Dropbox where you're doing something similar. It is a bit more work, but you definitely want to be taking notes. It makes
while you're going along. So the key is don't wait until the end of the year because you won't remember what that transaction was 9 months ago.
Absolutely. And two, sometimes like the tax softwares can actually miss things. I've seen issues with cointracking.info, for example, where they'll like randomly not pull in one Ethereum transaction. So it's a good double check as well if you have all your transaction hashes in a Google Sheet to make sure that the software actually pulled them in. Most of the time, like softwares generally will, and just maybe not like account for it correctly in terms of like tax keywords. But every now and then you're hit with a haymaker and it just randomly didn't pull in one transaction. So keeping logs is highly recommended.
Okay. Thank you.
Yep. So the fundamentals. There are 2 brackets when it comes to taxes for the vast majority of data sets. These are going to be ordinary income and capital gains. Ordinary income refers to income that is earned through regular business activities or services rendered, such as wages, salaries, commissions, and self-employment income. This is what most people earn. When you're working a job, you're actually a W-2, and anything you earn from that job is ordinary income. This income is subject to ordinary income tax rates, which are progressive and range anywhere from like 10 to 37%. Capital gains, on the other hand, refer to profit realized from the sale of an investment asset. This is where most NFTs are going to be. Other examples are stocks, bonds, real estate, and mutual funds. If the asset has been held for more than 1 year, it's considered a long-term capital gain and is subject to lower tax rates. If it's been held for 1 year on the dot or less, it's considered a short-term gain, and this is treated the same as ordinary income. So this is kind of where a great opportunity for tax advantage and tax planning further down the road goes, meaning if you buy an asset and you hold it for a year, rather than potentially have like a 35% tax bill on it, you may only end up with 15 to 20% if you have the patience to actually hold. And that's the advantage of doing so. Ordinary income is subject to taxation based on the gross amount measured at fair market value, implying that any wages earned, for example, in the course of employment will be taxable to the extent of the exact amount earned. That sounds like a load of gibberish, but the principle is rather straightforward and easy to comprehend. Like, for example, if you're mining Bitcoin, you hit the little lottery there and you mine a whole block. Let's say you earn 2 Bitcoin right there. You're going to be taxed on the fair market value of 2 Bitcoin. Capital gains, on the other hand, are subject to the difference between the proceeds and the cost basis. Meaning, if you bought an NFT for $100 and you sold it for $1,000, you're only going to be taxed on that $900 difference. And those are the very high-level fundamentals of crypto taxes. Most things are capital gains. Depending on what you're doing, ordinary income taxes may be involved as well.
So you mentioned NFTs. I'm assuming any crypto coin would also fall into the same category as NFT.
It depends on what you're doing. So like anything that you're buying and then selling is going to be a capital gain. Anything you're receiving for like doing something, like if you're playing a game, you're mining or you're staking, that's going to be more akin to ordinary income and taxed at fair market value. However, that like taxation event does become your cost basis. So like in the example I gave where you hit the lotto and you mine 2 Bitcoin, you will pay taxes on that. Let's call the fair market value 10 grand. But then that becomes your cost basis. So on those 2 Bitcoin, your cost basis is 10 grand. So if you wait a year to sell it and you double your money there, you'd have long-term gains on only 10 grand because your proceeds would be 20 and then your cost basis would be that initial 10. So it kind of depends on what you're doing, but it is fair to say, like, for the vast majority of crypto activity, that it is in capital gains land.
Well, let's put the mining out of the way, because in theory, you have more costs involved with mining, because you've got equipment you purchased, and so there's a whole separate category there. I'm talking about, I buy some Ethereum, or I buy coin XYZ,
Yep.
and that's treated the same as an NFT.
Yes.
Okay. There's a question from chat. How do you determine the fair market value of an airdropped NFT?
Great question. There's a very big gray zone in the moment. I'm not a huge fan of valuing NFTs just because they are so volatile. I think for the most part, if you're getting an NFT for doing just about anything, and it's like, you didn't have that NFT and now you do, so kind of like plus one in your holdings there, I would count that as income at like a nominal value, and I would just be consistent there. So nominal can be like a penny or $1, one of the two. That way, you're still complying with the tax laws and you will be paying taxes on that, but it's not such a large number that really makes a difference at the end of the year. The only exception to that would be if you were given something crazy, like if someone randomly sent you an actual Bored Ape, right? I don't think you should take that at income at $1. Not sure what your valuation would be there, but if you got a free Bored Ape, I would recommend hiring a professional to make that determination for you. Outside of that, though, like if you're just getting random NFTs, I would go the airdrop route at something nominal.
Interesting. So there's no connection to the asset and its value that got you the airdrop, because
Nope.
it's net new.
Yes. So like, trying to think of if you're playing a game, it's kind of where I see them a lot. Like I've had some individual clients play NFT games, and during the course of it, right, they'll get like new items, right? Unless those things are, have a ton of liquidity and it's pretty easy to determine like the fair market value, meaning, let's say you're playing like a role playing game and you get a sword, right? If you can sell that sword for any time and get $20, then it's probably fair to say, you an income event at $20. I don't think that's the case in most NFT airdrops. Kind of more what I see is like, oh, I hold a Bored Ape, so maybe I get a Mutant Ape, back in the day when they weren't so crazy. I don't think that Mutant Ape would have a crazy fair market value. I think it'd be fine to go with a nominal penny or a dollar. And, the more further away you get from something like Bored Apes and Mutant Apes, the easier that even becomes. Because like NFT valuations are sort of its own beast, and no one's really looking for the tax code isn't made in a way that like you should have to sell your asset because there are taxes involved. They just want their fair cut at the end of the day, and you really haven't been like enriched for just getting something yet.
So we've got lots of questions coming in. Do you want to keep answering questions, or do you want to get a little further first?
Sure. Let's go through some more.
Okay. The question here is, do you differentiate airdropped NFTs from spam NFTs? So what happens a lot, if you've got an active wallet, you basically get a lot of crap. And, so they're going to show up in the reports. Do you just basically give them a zero value because you're never going to sell them, right?
Yeah, so I think this is kind of a gray zone here as well. We don't have explicit answers from either the IRS or any courts or Congress yet, so keep that in mind. Kind of what I do for clients, though, is if it's an NFT that like isn't crap, for lack of a better word, I would take that as an airdrop route, nominal value, right? Income at a penny or a dollar. If you're getting a ton of spam, I see this a lot on like Matic, right? If you're well known in the NFT space, I forget what those bots are called, but I've seen like Killer and Kong a ton, and clients will get spammed like 1,000 Matic NFTs. We just sort of ignore those, and the implication there is that you can never touch them. So if you're going to like count it or not count it as income, you should never touch it in the future ever, even if it becomes worth a lot. If it does become worth a lot in the future and you do touch it, you will be subject at least to like an unmatched trade, which means short-term highest tax rate. Well, like of your progressive bracket, which is okay. But depending on like the dollar amount there, you may even want to amend. So as long as you're never going to touch it, I'd be fine with you not having to worry about it in the data set.
Okay, so then there's kind of like a category of take these things out of the data set.
Yeah.
Getting phase. Okay. Do we want to get into that one, Vo? So we've got this thing with MEX, and you're probably familiar with it. So it started out as an airdropped NFT. Okay. You took the NFT, you burned it, and you revealed a new NFT.
Yes.
And then you combined 7 of those NFTs into a new single NFT.
Okay, so we're doing what? Revealed or unrevealed? So
Revealed to assemble.
To assemble, okay. So the way I would handle this is that those are taxable events, but fear not, I wouldn't dive too deeply into like what's the fair market value of this transaction, because it's an NFT to NFT trade. I would make your proceeds your cost basis, meaning if you spend $50 for all 7, or like $50 each for the 7, you unveiled them, then your $50 cost basis, that becomes the proceeds. You have $0 capital gain or loss there. That becomes the cost basis of the new thing. And the same thing applies when you go from 7 to 1. In the 7 to 1 scenario, though, your 1's going to have a cost basis of like $350 because it's going to aggregate all 7 of them. And then vice versa, if you ever undo the 1 and get your 7 back, you would just kind of do the same thing. The other alternative is to try and figure out fair market value, which I'm not a fan of when it comes to NFTs, just because they're so like volatile and it's kind of like art, right? Who's really to say what it's worth? I think it's easy once you have something else in the transaction, like an NFT for ETH, because we can kind of evaluate what Ethereum's worth, but it's pretty hard as far as like NFT to NFT transactions go.
Okay. So then, along that lines, kind of the idea is, give each of those unrevealed NFTs, right? Unrevealed mech parts a dollar value because you got airdropped them. That dollar value kind of transfers over when you reveal them because you're not really selling them. And then those $7 collect into the mech when it's more about the point of sale. So if I sold some parts along the way and I took a profit, that would be against the $1 individual NFT. Whereas if I sold a mech, that would be against the $3.5 cost basis for a mech.
Correct. And so essentially, like, these are taxable events, but for the NFT to NFT conversions, the proceeds and the cost basis are the same. Also, proceeds is kind of just like what you're selling something for. Your cost basis is what you paid for it. So since they're equivalent, there's not really like a taxable difference there until like the very end of the chain, right? Say you get the mech for 7 mech parts that were dropped, so your mech cost basis is $7. If eventually you sell that for $1,007, then you have $1,000 capital gain that you will owe taxes on, regardless of what that new asset is, right? Whether that's Ethereum, USDC, if you got $1,000 of it in return for the mech, that's going to be the taxable gain.
Okay. More questions, and we're just going to keep going.
Sounds good. That's what I'm here for.
Good. What about, like, we do a lot of trading, so there's no real sale. I say I have this mech part, you say you have that mech part. We're both interested in each other's mech parts, so we just transfer them to each other, and there's no change of Ethereum or any coin involved. How do you handle that?
Kind of the same way as we were just talking about. Like, for each individual, they're going to make the proceeds of that first mech equal to the cost basis, and then the new cost basis on the new thing is going to be the same value. So, like, it might be easier to visualize on, like, Excel real quick. Let me open that up, just because I think numbers make this cleaner. So let's do proceeds and cost basis real quick. Can you guys see my Excel?
I cannot. I think you probably just shared a single window.
Yeah, let me change real quick. Change windows. Yep, here we go.
Don't share your whole... Yeah, there we go. Perfect.
Okay, so I'll zoom in a little bit. So proceeds, cost basis, gain and loss. So essentially, let's say person 1, right? P1, they bought a mech for $50. Person 2 bought their mech for $70. They trade these mechs, right? I would still, for person 2, make the proceeds $70, and same for P1, make it $50. So then your gain or loss is just going to be proceeds minus cost basis. So these still result in like no change as far as taxes go. And so if this guy traded mech 1 for mech 2, and this guy traded mech 2 for mech 1, his new cost basis for mech 1 for P2 is going to be 70, and for mech 2 on person 1 it's going to be 50. So like your tax positions aren't changing here. Although this is something the IRS could come in and argue about. The argument that they're going to make is rather than these being equivalent, the max at the time are maybe worth $100, right? And then that would change proceeds for both of these people to 100. And that's kind of where the IRS could come in and make an argument. I don't think it's worth doing for like singular NFT trades of low values like this. Anything under like 10 grand isn't something the IRS is really going to fight tooth and nail over. So I really wouldn't worry too much about it. But if you're doing it enough, or you have like a crazy one, like a board 8 for board 8, that might be something you want to like get actual
get more
advice on.
Yeah,
like professional advice and professional review if you're planning out with those kind of evaluations. But like for a Mac part, doing something like this is going to be fine. And then eventually, if you were to sell, Mac So if Kitchen 2 is going to sell Mech 1, eventually if he's got the 70 and he sells it for 350, the IRS is going to claim their cut on that 280 that he just made. So like at the end of the day, the IRS is still going to be happy because they're claiming like the profit. If that makes.
So Vo has an interesting question based upon this. So trading could end up being tax beneficial relative to selling and buying because you could realize a gain by selling.
No, just because you're resetting your holdings. Like the negative with this, right, is maybe you bought, like this person bought Mech 1 on 8/24/2022, right? So when he makes this trade for M2, like nothing really happens tax-wise, but his new Mech 2 or Mech Part 2, instead of having a holding date with 2020 on it, it's going to have 2023. So every time you do this, you reset your holdings, and kind of like the number one tax advantage you can take in crypto is long-term capital gains because those are taxed so much lower. So like that's kind of a negative. You can play around with it to a degree as long as you're willing to hold. But then on the flip side too, like you're not really claiming losses here, and losses are definitely worth taking sometimes as well. Meaning like if this was their cost basis 50 and 70, but instead of being worth 100 at the time, Mech parts or max if these are maxed are worth 30, right? You'd have capital losses here. So like there's a potential like lack of capturing losses, which are generally good. It's a really hard way. It's hard to like wrap your head around losses being good. I guess just being in accounting long enough, it's something that I like seeing for clients because you can use those to offset other things or carry them forward. So it's kind of up to you. There's not really a right or wrong here though yet.
Yeah. Vo, do you want to try to verbalize your question? Because I'm not sure I'm asking it right.
Yeah, sure. Okay, so previously before there were trades and before people were comfortable trading, if you wanted to, say you have like Mech 1, you want to effectively trade Mech 1 to another guy who has Mech 2, but you want to do it via marketplace so that, you know, the project gets royalties or whatever, you just want to make sure that nobody gets scammed. So the owner of Mech 1 sells their Mech to the owner of Mech 2 for $100, and the owner of Mech 2 sells their Mech to the owner of Mech 1 for $100, you know? So it's effectively a trade, but because they sold, I'm guessing that there's going to be, you know, it's taxable for that $100 price tag they decided to use. Is that correct?
Yeah, so essentially what they're doing is like hard coding in the proceeds. So unlike a normal NFT to NFT trade where no one really knows, you guys are both assigning a proceeds of $100. So depending on your cost basis, you might have a gain or loss. And you won't be able to argue anything different there because you can see the $100 in Ethereum on chain. Assuming it's something like OpenSea.
Yeah. Yeah, I guess that's one thing that is an advantage to our trading channel, I guess, is that instead of having to realize a loss by selling, you can just make a trade to a person individually. But it does limit like the number of trade partners because obviously, like if you want to do multi-way trades, like, it's a lot more difficult, and yet to have it in the marketplace, it's a little bit easier. So
yeah, that makes sense.
Yeah, something that I thought was kind of sad about how you know, NFTs get taxed is that a lot of applications end up being somewhat stifled because of the tax implications. Like you can't. It's very tough to have a marketplace effectively for Mac parts because of the tax implications of buying and selling.
Yes, I think if you daisy chain them, like, you know, you're doing one Mac part for another, it's not the end of the world, but if you start assigning values or if the IRS wants to go down there right, then you're absolutely correct, and it'll just hinder sort of trades, which ultimately would hurt the IRS's bottom line because they're all about getting more money, and that limits the amount of money moving, but I guess we'll see, right? We're pretty early into this.
Basically, it makes it really disincentivized for people to want to buy and list on marketplaces for these Mac parts. Because you end up having to realize the gain where if you were to try to find a trade for it instead, basically the only reason why you would want to buy or sell is if, or I guess the only reason why you want to sell is if you want to get rid of your position completely. But otherwise, it seems like, you know, trading is the way to go from a tax perspective.
So are there no marketplaces yet where you can just trade NFTs for NFTs, or is it always NFTs to like other assets?
It's very recent on OpenSea. There have always been other alternatives like Pseudo, but so many people got hacked doing that because they didn't really know what they were doing. So I'm looking forward to OpenSea deals, but unfortunately there are certain assets like 1155s that OpenSea deals don't support yet. So for example, like afterglows, you can't really trade those yet through OpenSea at least. You can do person to person, but that involves an amount of trust. So previously, a lot of times we'll just go through the marketplace, which that's not going to be great for tax purposes.
Yeah, it sounds like someone almost needs to make like an escrow marketplace. That's something like multi-sig sort of trade marketplace would be cool.
Yeah, something like that would be nice. The main thing is just like, the reason why barter economy is not as great as like, being able to actually buy and sell things with money is that you don't need mutual coincidence of wants. And trying to find that through the Mac marketplace can be difficult if you're limited to just trading. So, it's unfortunate that, that we're disincentivized to, just be able to buy and sell things in the marketplace, make it a lot easier.
Yeah, agreed. Hopefully that gets fixed over the next couple of years or sooner.
There's another question here. Sorry, Vo, were you done?
Yeah, I'm all set. Thank you.
Further had a question, so burning NFTs, just to confirm, the assumption that the proceeds of your burned NFT is the same as your cost basis, and that the new NFT you receive now has a cost basis of 0. What I heard was the opposite, that you're basically just transferring the cost basis over. So if you bought a unrevealed mech part for say $50, okay, and you burn it to get a revealed mech part, that revealed mech part is now $50.
Correct. And then your proceeds on the first one would be 50, which then is a net 0.
Cancels it to 0, but the 50 transfers over. I think that's the difference further, is the cost basis of the new NFT is not 0, it's 50.
Yeah, so you're essentially just kind of making like a daisy chain until you finally fully exit. So your 50 would go from the first NFT to the second, and you kind of just keep applying that until you eventually exit out of NFTs into a different asset.
Okay.
Awesome.
Keep going. I think that helped. We got a lot of the basic questions out of the way.
Awesome. All right. So here we're going to kind of go through some of the more like typical keywords and what's taxable and what's not. So as far as trading goes, right, selling a digital asset for fiat is going to be a taxable event. This can be like Ethereum for USD, or maybe you're selling an NFT to your buddy for cash. What you receive in return is going to be your proceeds. Trading one digital asset for another is a taxable event because essentially that's a sale of one asset for a buy of another. All sales are going to be taxable. And then finally, buying a digital asset with fiat is not a taxable event. Something like mining and staking are going to be ordinary income. There are some caveats here. I think mining is pretty well received as it's going to be income. Staking is still up for debate a little bit. The IRS is hampering down on the position that it is ordinary income, but that isn't final. To be safe for now, I would treat it as such until the courts or Congress decide otherwise, or the IRS drops their position. But TBD on those, we'll probably find out in the next couple of years at the rate things are going. Airdrops are ordinary income upon the date received at fair market value. The kind of tricky part here for most airdrops is what is fair market value. There are some pretty famous ones like ENS, which I could tell you if I saw your transaction hash. There are other ones like getting a random NFT where that's really up for debate, and you can use something nominal or do a lot of research on your own end. Scam airdrops are a bit of a gray zone due to a lack of guidance. There's an aggressive but arguable position that they can be ignored in the data set. If this position is taken, you can never touch them in the future. Another position that's kind of creative, and I hope someone uses it eventually in a court case, is you can argue that those are gifts received with a $0 cost basis. It's not exactly what the tax code is looking at as far as gifts go, but you're kind of just receiving crap and you can't say no to it, so it's kind of a very unique situation. So we'll see in the next couple of years when things get litigated. Lastly, we have lending and rewards. So at a high level, these are really highly fact-dependent. From a principal stance, right, they're going to be non-taxable outflows and inflows, and the general fact pattern behind them is I send in 10 ETH, I get back 11 because I made some money, and so that 1 ETH difference is going to be income. The problem becomes when the liquidity pools do more than that, meaning like if you send in 10 ETH and you get back, 10,005 USDC, well, there's sort of like a hidden taxable event in there, and figuring that out is kind of a pain. Hence why I said they're highly fact dependent. So if you're going to be doing liquidity pools, look into how the data actually looks before you dive deeper. If you're going to be getting back whatever you put in plus more, those are generally really easy. If it's any other kind, they're going to be a little complicated, and you're just going to want to take some really good notes. Next, we have forks. So a soft fork is just an upgrade. Right? This was like the Ethereum merge, I think, from last year, if my memory serves correct. So this doesn't really change anything as far as tax position goes. You have no income. Your assets didn't really change. That's different from a hard fork. This is when like a new permanent chain arises from the separation of the original and the new. A very common one is Bitcoin and Bitcoin Cash. So like if you had 2 Bitcoin at the time and then you got 2 Bitcoin Cash, that's going to be an airdrop, which is a taxable ordinary income event. The dilemma there kind of becomes like, what's Bitcoin Cash worth? And, like when a chain splits, there's so much volatility that fair market value is very arguable. But you're going to want to do some research and try and find a number you can live with. Additionally, another strategy is right after a hard fork is to sell about like 30% of the new assets you get. That way, come tax time, you have a good position point as far as like pricing oracles go for the airdrop amount, and then you have the actual tax money that you sold from the 30%. So you're not in like a painful position come next year when you owe money on paper, but you still don't actually have money if the chain goes to zero. Lastly, we have some losses. Go ahead.
Let's halt there for a minute, because the fork last year was a hard fork on Ethereum.
Oh yeah, ETH and ETHW. I haven't had to deal with it too much just because there's an argument to be made there as well of like, are you claiming the thing? If you never touch it, you're probably fine, although you do have more assets. I've only seen one client out of probably everyone that has Ethereum that actually touched it. Everyone else is just kind of sitting in the void. So, but ETHW on paper with our current tax laws would be a taxable airdrop.
I see. Okay, so they hard forked. You don't have to do anything with the new stuff. That's just like a 1-to-1 basis. But if you try to go...
No, so that new stuff is income. But there is an aggressive position that if I never touch it, it really wasn't income. And...
Define new stuff.
ETHW versus ETH. So like anyone with a MetaMask that had Ethereum at the time of the fork now has ETHW that they can access through the same seed phrase, right?
Interesting. So I consider ETHW not the new stuff, and I consider the ETH the new stuff because it's a new chain.
Do I have them backwards in my head? So to me, Ethereum's like the Ethereum everyone thinks of. ETHW is the new chain that resulted from the fork. Is that your viewpoint, or do I have them flipped?
Yeah, I think it's they flipped it. So when they transitioned, they called the old stuff, the original stuff, ETHW. ETH, because it's got to keep the same name.
Yeah.
Through the hard fork.
I see. So it's kind of like 2 in 1. So the new stuff, basically as far as data goes, like nothing really changed. So I wouldn't make that an airdrop. The new stuff in the sense of like there's a second chain that no one uses, that new stuff is going to be an airdrop.
Got it. So if you don't touch it, which hopefully no one did because there was all sorts of scams.
Yeah, chaos. How to even access it.
Yeah, okay. So hard forks, as long as you don't touch it, not an issue. Okay.
Well, that's an aggressive position. So we'll see how it goes. I'm fine with clients taking that. It's one I've taken myself just because I don't want to deal with that headache and I'm not really like enriched. Essentially, like the core of our tax code goes to ascensions of wealth. So when you now have more wealth, generally that's kind of where like a taxable event occurs, whether it's more or less, right? To me, ETHW isn't we're all richer, right? If we were all to have more coins in our MetaMask, like say tomorrow everyone got dropped wrapped Bitcoin,
yeah,
that's pretty clearly we're all a little bit richer. The IRS is going to want their cut.
It's more like a transfer. You could qualify that as a transfer from the old to the new. Okay. there was also a question about wrapping and unwrapping ETH.
So my position is that those are taxable events, and most people aren't going to like that. The position I take, like the technical reason behind that, is because they have a different contract address. So when you're changing contract addresses, that's the actual token. So like that's the reason why I say it's taxable, because wrapped ETH has a certain contract address on Ethereum, it has a different contract address on Matic, and those are actually all unique cryptocurrencies. So to go from one crypto to another is a taxable event, hence wrapping is also taxable. I've seen clients say they don't want to take that position. I think for the most part, wrapping is not the end of the world, because you're only going to have gains on paper if you've held an asset for a long time. So like if that does occur, you should be aware of it and just set aside like 20 to 30% and then carry on with life. Alternatively, you can take the aggressive position that they are non-taxable. That just becomes a lot more time or cost if you're going to professional for the actual reconciliation.
On a separate note, I'm trying to make a link in my head. If I leave the U.S. and I have $1,000 in U.S. currency in my pocket, and I fly to Paris, and I get off the plane, and I stop at one of the exchange points, and I exchange 1,000 U.S.
Well, so the problem there is that's currency. And so like at least in the U.S., we don't count crypto as currency, at least not tax-wise. We count it as like property. But I think a better way to view it as far as fact pattern goes is like, what if you left the U.S. with a nice watch on your wrist, right? And then you went to, I don't know, Britain and sold it for some pounds. The IRS is going to argue that like, hey, we want our cut, assuming you made money. Sort of painful, but those are the rules currently.
Asset versus cash. Got it. Okay. A couple more questions here. How do you handle NFTs like ENS names, which are basically a subscription versus a purchase?
So ENSs are really fun. When you buy them, whatever you paid for it goes into the cost basis of the ENS NFT. So for example, if you paid gas fees that were like $10 and you paid $200 for the actual ENS, then your ENS NFT would have a cost basis of $210. You could actually sell that to someone else, right, and have like a capital gain or a capital loss. And then if you let it expire, you don't get like a tax benefit. The ENS just leaves your holdings in like a non-taxable outflow because you didn't trigger a disposition event. So a kind of tax planning route you can go is prior to the expiration, you can try and sell it for cheap to realize a loss. But if you just let it expire, currently there wouldn't be any tax loss that you could claim there.
Okay. And then along that same lines, what do you do with all these transactions we've been talking about? So, I paid gas for an airdrop, or a claim instead of an airdrop. How does that get accounted for? Does that reduce my cost basis?
It would actually increase it. So like if you're minting an NFT, right, and the NFT was free to mint, and you spend $10 on gas, it's kind of akin to like selling the $10 but calling it gas, and then that $10 becomes your cost basis on the NFT. If you're claiming an airdrop like ENS and you got $200 worth of ENS, your actual gas wouldn't change your cost basis on it. It's just kind of like into the void. It's the unfortunate nature of being in crypto. I think those laws will change eventually. I think all gas transactions will, or like the gas part of transactions will be like a deduction, hopefully, once Congress catches up, but we're probably like 3 to 5 years away from that. So for now, the safest route when it comes to gas is like include it everywhere you can. So when you're buying or selling stuff, or you're minting things, and then everything else is kind of like into a void that doesn't really help you for taxes. Alternatively, there is an aggressive position where like they're not taxable events, and it's just leaving your holdings. I'm not a fan of those, just because there's an argument to be made that you're like paying for a service, but there isn't an explicit answer yet from the IRS, courts, or Congress. So TBD.
What about along that same lines? I use a marketplace, and the marketplace. So I sell an NFT for 1 ETH.
Yes.
And then OpenSea takes 2.5%, and there's 2.5% of royalties on it as well.
So any fees like that reduce your proceeds. So if you actually sold something for 1 ETH, but you only got 0.9 ETH, you actually only sold your NFT for 0.9.
Okay.
So that does help at least.
Okay. Another question here, would the fair market value of a claimed asset be based on the time of the claim or the time you were eligible for the claim?
Technically, it's the latter, the time you were eligible for the claim. I think for the absolute vast majority of data sets, you're fine with when you actually get it. If audited, the IRS can try and dig into it if they want, but I've had to do that for a client before, and it's really painful. So like, the way tax lawyers view it is it's like you have money in a tip jar, and so that's like the new thing. And so you can take the money out of the tip jar at any time. So it's not a taxable event when you take the money out. It's a taxable event when the money goes in, and that's when you can claim the airdrop or the new asset. I think in practice, though, it's very rarely going to be the case. The only time I'd say it'd be a big deal is if it's like, a lot of money and a very volatile price.
Okay. Yeah, and back to airdrops and claims. I mean, technically, you're going to give them a cent or a dollar anyhow, so it's somewhat irrelevant of.
Yeah.
Okay. Okay.
Awesome. Next thing we have is giving a gift. So these are non-taxable outflows, which are fun, and there are some special rules here. If you're giving away a gift to a single person, say I'm giving Cart Arl a bunch of Ethereum, if in total that's over 16,000, it's on me, the donor, to file a gift tax return. That's probably not going to change anything as far as like my actual financials go, because we do have a lifetime exemption currently at 12.06 million. That number does lower in the upcoming years, I think back down to like 5.85 million or 6. But for the vast majority of us, that's not really a huge issue. It is something, though, you will want to file the gift tax return if you go over the aggregate threshold. The next thing, too, that people do a lot is donate crypto to a charity, and there are special rules here which are kind of painful. And so these are the caveats that you need to be aware of. Your charitable contribution deduction is equal to the fair market value of the cryptocurrency if you held it for more than 1 year. Meaning if you had long-term holdings, you can deduct the fair market value. Additionally, like charitable deductions are only valuable if you are itemizing your deductions on your tax return. If you're taking like the standard 12.5K, these don't change anything. So if you're going this route, like your $50 donation to, let's say, Ukraine last year, isn't going to change your tax position because odds are you're still going to take the standard deduction. The next rule, which is really painful, is if you held the cryptocurrency for 1 year or less, your deduction is the lesser of your basis or fair market value. Essentially what the IRS is preventing you from doing here is like double claiming a loss. The strategy you can do for that is to actually change the asset, say from like Ethereum to USDC, and then gift to USDC. But that's something that a lot of people don't consider when they do it. The next rule is if your donation is over $250, the charity should provide documentation. Often this is like an email receipt that most people receive when they do so, or if you went to like a Goodwill and you get a little printout, you need something like that for documentation. Finally, if your donation is in a crypto or an NFT and it's over $5,000, the charity is required to sign your donor form, 8283 specifically. Additionally, you will need to get your donation appraised, and you cannot just rely on market valuation tools. I think that's really painful, but that is what the IRS has recently come out with statement-wise. So if you donate a ton of ETH to a charity, you have to hire a professional appraiser, which I haven't heard of one yet myself, and get them to like actually come up with a fair market value on the thing. You can't just throw it into a software or look it up on CoinMarketCap. All right, next we have receiving a gift. This is also pretty painful for crypto. Get a new job, NFT appraiser. Yeah, I can't wait to see what their process ends up being for that. So receiving a gift is a non-taxable inflow. It means you don't owe taxes on it. But the cost basis and the holding date is where it gets tricky. So your basis in virtual currency received as a gift depends on whether you will have a gain or a loss when you sell things. Meaning what happens in a gift normally, like if I were to gift Carl some ETH, he inherits my cost basis and my holdings. the IRS wants to disallow those loss transfers. So if I gifted him $100 worth of ETH, he eventually sells it for 50. His cost basis on that original ETH isn't going to be 100, it's going to be 50. Since essentially he's made richer and shouldn't get like a deduction for it or capital loss. For purposes of determining whether you have a gain, though, it's going to be the donor's basis. So if it was $100 worth of crypto and he sells it for 2, he's only going to have to pay taxes on that $100 spread. And there are some documentation issues, though. So when you're gifting something to someone, you should provide them a gift letter, is the tax term. Alternatively, just any sort of documentation that shows the basis and the holding date will work. Doesn't need to be super formal, but you are going to want to give your donee something to showcase both of those. If you can't prove it, if Mike never gets that from me, his virtual currency holding date is going to be the date he receives it plus 1, and his cost basis is going to be 0. So a lot of times I see friends send ETH back and forth, and they don't provide gift letters, which means you now have a $0 cost basis on whatever you received. And like, let's say you got one Ethereum, and that was worth $2,000, and then you traded it for an NFT, you now have a $2,000 capital gain. So it is something to, keep in mind when you're doing stuff with others. And then finally, if you don't have documentation to substantiate that it is indeed a gift, right, the IRS can challenge this. Either they're going to give you a $0 cost basis or say it's income. Either way, both of those are pretty painful and can be avoided just by some planning before you do your actual gift events. This is also why I like commingling things, like going in on NFTs together or just sending things back and forth a lot, or it can be quite painful. The solution to a lot of that is just to keep a good transaction log. Have written records before you do it. Have written records of like the hashes, what was sent, what's the valuation of all of these things, and stuff like that. Then a good accountant or tax attorney can try their best to turn it into more of like a loan situation, which is often what is actually occurring. But it is very fact dependent again. So moving on to navigating NFTs. So mints are generally a buy of the NFT for paying a transaction or gas fee. So like, for example, if you spend $20 on gas to actually mint the NFT, that's going to be a sell of Ethereum with the $20 proceeds, and then that $20 becomes your cost basis of the new NFT. Another thing that happens a lot is like you can mint multiple NFTs. So if you spend $20 in gas and you get 5 NFTs, each of those NFTs is going to have an equal $4 cost basis. So you would just spread it equally across the volume. So buying an NFT is non-taxable, but if it's purchased with crypto, then the sale of the underlying crypto would be taxable. So here's like if you're doing Ethereum for an NFT, the actual NFT purchase part of the transaction is non-taxable, but the Ethereum outflow is going to be taxable. So here's some examples with some numbers. So you mint one NFT for 0.1 ETH. ETH is worth $300 at the time. So that's akin to selling 1.1 Ethereum at $30. There will be a gain or loss here depending on the cost basis. So this $30 is your proceeds. The purchase price or cost basis of the NFT is then the third is the proceeds of the other side of the transaction. So here this is also going to be $30. Another thing too, as well, is if you're paying $30 and then there's a $10 gas fee, you could throw in the gas fee into the cost basis of the NFT. So this is kind of where you can take advantage of doing things and not having to pay gas, so it's not into the void. Example number 2, generally the values for the cost basis and proceeds are determined by what is sent or received in the purchase or sale. For example, a purchase of an NFT for 1 Ethereum, with Ethereum being $1,000 at the time, would result in a cost basis for the NFT of $1,000 plus any gas fees if applicable. If that same NFT is later sold for 2 Ethereum and the price hasn't changed, then there'd be a $1,000 capital gain. Depending on the holding dates, you'd have short-term or long-term. The next thing that I see a lot with NFTs are like receipts. So this can be from something like crypto gaming, and this is income at nominal values, like a penny or a dollar. Another thing I've seen more frequently is like actual receipts. So like say you buy something physically, or even if it's another crypto asset, and then someone just sends you like NFT receipt 1, and that just proves ownership. That would just be more of like a gift in at a $0 cost basis. You wouldn't have to treat those as airdrops as long as you could show that it's related to the other thing. And then finally, gifting NFTs such as to friends, acquaintances, or family can pose a lot of challenges, which we've gone over in some previous slides. So for gifting events surpassing, I'd say around $10,000 is my rule of thumb, or if it involves a notable collection like CyberBrokers, I highly recommend getting an expert tax counsel before you do the actual gifting event. And then lastly, we're going to do some tax loss harvesting exploration. So to qualify for a capital loss on NFT, you need to initiate a disposition event. In the past, there was a lot of talk about like taking a worthless security position. This has changed recently. I think it was in January of this year. And the IRS basically said that's not allowed. So the most secure method to trigger a disposition event is to actually sell the thing. And this doesn't even need to be for anything. So you can sell it for $0 on OpenSea, akin to like giving it away for free, and that would count as a sell for $0. When this isn't possible, an alternative but more aggressive option is to actually burn it. You would burn it by sending it to an address like the 0x0, like the whole thing is zeros, or the other one that's 0x0, bunch of zeros, and then like dead. Those are common ones that I've seen before. And the only way I would recommend this position is if no one actually wants your NFT. Meaning it still can like actually be traded. You know, there are tokens where sometimes the developer locks the trading option for the actual token. That's not here. What I mean by cannot be traded means no one took it. You put it up on OpenSea for like a month for $0 and it stayed there. So I would document the date you put it up, screenshot it, or document it a month later, no one took the thing, and then burn it. That'd be a more safe option compared to just burning it without trying. And then for that burning event, when you send it to like the dead or null wallet, that'd be counting proceeds at $0, so you'd get tax loss of whatever your basis is. So for like low value NFTs, this is a lot of work. If it's a high value NFT that got rugged, like let's say you put $1,000 into an NFT, this is probably worth doing. If you only put like $2, better just to burn it and not count it as a capital loss. All right, so that was tax loss harvesting, and now we're going to go through strategic long-term tips. So my number one tip for everyone always is keep adequate records. So here you're going to want to keep an inventory document. This is kind of where clients go wrong a lot of times. Anytime you make a MetaMask, a ledger, open up an exchange account, have a singular document that says, I used a MetaMask and here's the address. I used Kraken or Binance US, etc. Just by keeping this, it'll make your life significantly easier in the future whenever you decide to do a crypto reconciliation. The next thing I highly recommend, which is unfortunate, this has to be advice, is to download your exchange data on like a monthly basis and keep backups. The reason I mean that's unfortunate is because exchanges shouldn't go kind of kaboom like FTX or Mt. Gox, and then that data is lost. And depending on what you did, having the data can make your life a lot easier, especially if you did a lot of trades or you sent assets back and forth a lot. So your data is really important when it comes to crypto taxes. The next thing you can do is keep a log of linked transactions. Here, what I mean is like you can have one column that's just your transaction hash. The next column can just be your notes. It doesn't have to be anything too complicated. I think this is what Carl was talking about earlier, where Bitcoin wallets have like a note feature already embedded into them. That would be perfect. Unfortunately, MetaMasks don't have that yet, and hopefully that does get added over time. And then my final piece of advice when it comes to records is keep a timeline of big events. Right? It doesn't matter so much if you get airdropped 10 nominal NFTs, but if you do buy an NFT for $5 and sell it for 10 grand, that is something that you're really going to want to double check and make sure it's accurate at the end of the day. The next advice is going to be don't commingle assets. I see this a lot, especially with individuals. People like to go into sort of like partnerships or joint ventures together on NFTs or certain crypto activity. That's not really too bad as far as like the financials of it. What's really complicated is actually getting the data to work. None of the crypto tax softwares were created with this in mind, so there isn't a singular one out there yet that can do commingling easily or well, which means if you're going to an expert, you're going to be paying them pretty chunk of a penny for something simple. And then alternatively, if you're doing it yourself, you're going to be spending probably like 12+ hours. And to me, that's a lot of time. So if you can, just avoid commingling. If you are going to commingling, my recommendation is to make a new separate wallet. So don't commingle on like your buddy's wallet. Make a new EVM MetaMask wallet, and then have that be sort of like your joint venture partnership wallet. Finally, always report your activity, even if it is just losses. So losses can help negate gains in the long run as they carry forward. I see this a lot on like Reddit, where people are like, I lost $600, it's not worth doing the taxes. Well, next year, if you made $600, that loss would carry forward, assuming, let's say it was $3,600 actually, then you'd have a $600 carry forward, which would negate that $600 gain from the next year. So losses do carry forward if they exceed $3,000 in total. Additionally, the next thing that's useful there is that by doing your crypto taxes every year, you have your holding dates that are actually accurate, and that's very valuable. Say you have an NFT that you held for a long time, and then it popped off, and you want to claim the long-term capital gains. So I highly recommend doing it year over year, even if it means just reporting the losses. The next part of this is the IRS generally has 3 years to audit your activity, and under certain rules, they have up to 6. That's a lot of time. I think most clients aren't doing their crypto taxes year after year. A lot of times I see people do them kind of like in the big ticket years, like 2021 when there was a lot of gains, or 2022 where there's a lot of losses. And I imagine a lot of people might try and skip 2023. I highly don't recommend it because if you get audited for, say, 2023 and 3 years from now, you're going to have a really hard time trying to remember what you did. So do it while it's fresh in your mind. And then finally, not reporting prior years can mess with your cost basis and your holdings in the years that have major crypto activity. So what I mean by this is like the final sum of crypto reconciliation is a final holdings report that has all of your assets broken out into various lots, and each of these lots have their own unique date, their own unique volume, their own unique cost basis. If these aren't correct, it can really mess with your gains in the future. So you may think you have something for a long-term capital gain, but your actual tax report says otherwise. So instead of paying 15 or 20% on that gain when you trigger it, you may owe 37%. And that can be more than double. So very painful error, and I highly recommend avoiding it. And then finally, the free prize at the end of the tunnel is the Crypto Hub access. So this is something I developed with my firm Founder CPA. We have a bunch more materials in there, a lot of slide decks, a couple videos. Some of the slide decks are crypto tax fundamentals. We have other ones on frequently asked questions, tax treatments of the more complicated gray zone cases such as scam airdrops, or providing liquidity, wrapping, unwrapping, and bridging. We have another section on data nuances. And then finally, we have a community portion of this where you can ask questions at any time. So even if you don't have a question today, you can sign up for this. It's free, I think, until Friday or the end of the month, one of the two. And you can ask the question when it becomes relevant, say, next February when you're doing your taxes. And so the sign-up links are here. The first one's kind of hard to see. The second one I will paste in chat for us, but it is tinyurl.com/
Yeah, don't paste it in chat. I will paste it in our holders area.
Perfect. Let me know if you need a DM of the link or if this is enough. Try to keep it simple. So
yeah, that's good.
Perfect. And if you go to that link, it should just have 100% off discount on the screen. So you can just type in your email and then sign up. No credit cards needed. That was my whole presentation. I think I've gone through a lot of the questions already, but if anyone else has any more, feel free to ask, because now is your opportunity.
I have one big one.
Sure.
But let's say the IRS makes a change, next year and decides to not count on anything capital gains anymore.
Yes.
I understand that's probably not going to happen, but I'm just putting it out there. How does that affect previous years?
So what you could do is amend your previous tax return, say the rules change. There are some limitations there, as I think you can't amend things after like 3 years for the general. Well, you can't do past 3 years, I believe, to like claim money back from the IRS. Kind of same in line with like the audit rules for them to audit you. The kind of your limit. So So that's kind of what you would have to do. You'd have to like redo your data set depending on what rule changed. If capital gains no longer applied, you would just amend your tax return and get rid of your cryptocurrency activity all over it. Be really shocked if that does happen. But like I see being more realistic of like the possibility is, say the IRS says staking isn't income anymore, right? They give up on that. What you could do is amend every year possible and remove that staking income from the calculations. You'd have to reset your cost basis on all your staking lots to $0 since it wouldn't be like a taxable event at fair market value. So that would change all of your numbers potentially, like your capital gain proceeds, cost basis, and net results. And you would do that by amending, and hopefully you don't have so much activity far back that isn't recapturable, but TBD. And like very specific to each data set.
So the next question, and people, yeah, I'll stop after this one if other people want to voice chat questions, or just type them into voice general. States tend to have, like I live in New York, which is a very crypto legislative heavy state.
Yes.
Are there different rules per state as well, and on top of all these countries?
So I haven't seen that apply to a data set yet, but I am aware of one for Arizona that I think applies for 2023 data sets. So it is something I may have to investigate next year when I'm actually doing those data sets, but unfortunately the answer is yes. Say the IRS says staking is an income, but New York says it is. That kind of means you'd have to like do your data set maybe twice. It's a really unfortunate and complicated situation to be in if that does apply to you. So I'm really hoping states kind of just default to whatever the federal government says, and they keep things simple, but who knows?
The kind of follow-on question to that is, some states like New York heavily regulate which things you're allowed to buy and own as far as crypto is concerned. How do you deal with that from a federal government perspective?
So no one, including the state of New York, is going to say no to tax revenue. So they all want their cut, meaning like finance, original or international, whatever you want to refer to it as, isn't something most of us can access without a VPN, right? Because they block us out. Doesn't matter. If you somehow get a Binance account and you are trading on there, you should be reporting that activity, even though Binance is banned by the United States government. The IRS ultimately wants their cut. I mean, there are some pretty fun court cases where they don't even really care if it's like illegal or illicit activities. They still want their cut. So at the end of the day, they're always going to want their portion of taxes.
Yeah, for me in New York, it's something as simple as like Tezos. I'm not allowed to buy Tezos through Coinbase because I live in New York.
That's wild. So I mean, you know, and hypothetically, if you were to go and somehow buy Tezos, you would still be reporting that activity. That almost seems like New York may try and come after you criminally, which is insane, but I guess that is how some states are going. As far as like the IRS cares, they don't. They just want their cut of any money you make or any gains that you occur, or any gains that you capture.
Got it. Other questions from people?
Really good questions, though, by the way. I think we might be out.
Give him a minute here. I'll got a couple of thank yous. This was awesome. I think just talking about and listening to others and their ideas, and helps you think about your own situation, because we all have very different situations.
Absolutely.
Yeah.
So the best way to ask a question is to sign up to the Crypto Hub, and at any time you can go to the crypto community forum and post away. Fair warning, there isn't like a super rapid response time on those. It's within probably a week. So if you post say tomorrow, and tomorrow's Friday, I wouldn't be shocked if I don't get to it till like Monday or Tuesday. So just keep that in mind, but I will make sure to respond to all of those in the hub within a week, give or take.
Perfect. Okay. we went just a little bit over an hour, which was perfect. Justin, I appreciate you and Founders CPA greatly taking the time to come and chat with us and help us better understand the unfortunate side of dealing with the fun side of crypto NFTs, and also for the offer. So everyone should make sure to go to the holders only channel, and you can get the offer code and link there to go sign up. And what's it exactly called again?
Crypto Tax Hub.
Crypto Tax Hub. Perfect. A couple more thank yous.
Awesome. Well, thank you for having me. I really appreciate it. This has been fantastic. It's always great to get community questions as you guys come up with things I would never think of. So it always keeps me fresh and on my toes and helps me kind of like know what to look into in the future as things get more complicated. So appreciate it, guys, and have a good one.
Thank you. Good night, all.